Okay, so good morning once again, professors. Today I want to continue the final accounts, but specifically we are looking at adjustments to the final accounts. So what we are basically going to do here is it does happen that sometimes certain things might not have been, added to the final account or to the account while we were doing the double entry. So for example, maybe we forgot to record certain sales, or we forgot to add on a particular rent amount we paid. Okay, so there can be omissions or duplications or any other error in the balances as they stand in the trial balance. So when we realize or when we identify these issues, we need to adjust. So adjustment here means that we are going to be doing more of, corrections by either adding on or subtracting, okay, to some of the items on the financial statement. So let's look at what adjustments are technically. So adjustments are corrections, like I just said, or further workings that are effected in the final account. So there are corrections you have to do or further workings you have to do. So correction could be that maybe your sales figure is 100,000, but in constructing the trial balance or maybe doing the postings from the day books to the ledger account, you made a mistake, right? So you'd have to correct your sales figure in the final account. It can also happen that you paid rent of 5 million Ghana cedis in the first 3 months. The subsequent 3 months, you paid another 5 million. But in preparation of the account, you didn't bring on or you didn't add the second tranche of payment. So you'd have to further add that amount to your rent to get the total rent for the year. So adjustments are basically about making corrections or doing further additional subtractions to items in the financial statements. Now, there's also another thing we do, which is called closing entries. Closing entries. What are closing entries? Professors, you and I would agree that if we pick our element of accounts or accounting, we have assets, we have capital, liabilities, expenses, and income. Okay, now, when you are presenting your final report, note that you are doing a summary to help your users, use it for decision making. So there are some information you have to compress. Now, out of the 5 elements I've stated, those that we compress are the expenses and income, right? We compress them into profit or loss. So what it simply means is that all the account you have, like rent, telephone, whatever, we close all those accounts into the profit and loss account. So the point I'm trying to make is that those accounts are temporary. They are temporary in the sense that at the end of the year, we have to transfer all of them to the profit and loss account. When you look at the income like sales, discount received, all those accounts, at the end of the year, you move them to the trading and profit and loss account. How can you move account balances from temporary account into permanent account? You do that by passing a closing entry or making a closing entry. Please, am I making sense? just to reinforce what I said, what I'm saying is that we all appreciate that when we do the double entry, right? When you are doing your debit and credit, debit the receiver, credit the giver, or whatever, you prepare numerous accounts from sales account, purchases, cash account, bank account, rent, salaries. When you finish, you summarize them and put them in a trial balance, right? Now this trial balance ends up helping you to prepare your trading account and profit and loss account. In that account, what are you doing? You have just moved all those balances on the temporary account into this permanent account. Okay, that is the reason why if you pick a sales account, at the end of the year we write it off to the trading account. But for the assets, like I mentioned, the fixed assets, the current assets, they go back into the balance sheet, okay, and then they continue. They don't terminate as temporary account. They continue as permanent account. Okay, but if you have a sales account for say 2025, in the next year, 2026, you'd have to begin a fresh sales account because the old balance would have been transferred to the trading account to help you determine your gross profit or gross loss. So we do that by view of the closing entries. Professors, any question? Okay, so closing entries are just entries or general entries made at the end of the accounting period to transfer temporary account balances to permanent account. And I've given you an example of this temporary account, and the permanent account are the profit and loss account, the trading account. Okay, let's move on. Now there are 10 of the adjustment and closing entries we have to make, okay, for your level, 10 of them. So we have to discuss each and every one of them and then look at how they are effected in the final account. Okay, so at this point, I think I'll hold on for one of you to take us through the 10 adjustments as you see on the screen. Prof. Austin or colleague, can you do the reading for us?
Except the list and
Yes, so read this for us.
List 10 basic adjustments to final accounts of a sole trader. Explain the following and show the accounting treatment in the final account. Accrued expenses, prepaid expenses, income owings, income prepaid.
Okay, the next. Please hold on. Okay, so let's look at yeah, please continue.
Adjustments to final accounts of a sole trader. Adjustments are corrections made on account or further workings that are effected in final accounts. The following adjustments are made to final accounts. 1. Accrued expenses. 2. Prepaid expenses. 3. Income owings. 4. Income prepaid. 5. Goods withdrawn for owner's private use. 6. Cash withdrawn for owner's private use. 7. The proprietor's private expenses charged against the firm's expenses. 8. Provision for depreciation. 9. Bad debt and provision for bad and doubtful debt. 10. Interest on loan.
Okay, thank you very much. So just going back, so the objective of the lesson that we expect to know the 10 basic adjustment, which we have just read, right? And explain some of them. So amongst the 10, one of them is accrued expense. So we'll get to know what this is. Prepaid expenses, I'm sure you'd appreciate this from the explanation of the balance sheet. However, I think we'll dig deeper in this regard. And then for the fifth point, we have goods withdrawn by the owner for private use, cash withdrawn. Actually, there's 5, 6, and 7 is talking about drawings. Okay. Now, drawings is not only goods or cash. Sometimes the owner can also add his or her private expenses to that of the business, and that is also a form of drawings. Then we look at provision for depreciation, bad debt, provision for bad debt, and interest on loan. So, professors, let's pick the first one, number 1, which is accrued expenses. Accrued expenses. Prof Josephine, please, can you read for us? I think today we'll do one lady, one gentleman doing the reading.
Yes, please. Accrued expenses refers to an amount of expense that have been incurred but not yet paid for. It is also called expenses. It is also called expenses due or as outstanding or unpaid or owings. Accounting treatment in the final account. Profit and loss. Expenses due is added to the expenses paid and the results debited. Balance sheet shown as a current liability.
Okay, thank you, Prof. Josephine. So, professors, what she read, the things I want you to note are that accrued expenses are also called expenses due or expenses outstanding or expenses unpaid or expenses owing. Okay. Now, let me give a scenario so you can understand. If you were a business who is renting maybe a store at the market, so you pay rent expense to the owner of the shop or the store. Okay. The point we are making is that if, for example, the year 2024, you didn't pay rent of say 3 or 4 months, right? You might have paid the 9 months. But if you have not paid for the 3 months, then that constitutes an expense accrued or an expense owed. What it simply means is you haven't paid. However, when you are summing up your expenses for the year 2024, you will not exclude that amount you haven't paid. Please listen carefully. If you are looking for your expenses for the year, which is 12 months, you can't say that because you haven't paid for 3 months, you are not going to include that. So yes, you haven't paid, but it still forms part of your rent expense for that 12 months period. A typical example is, say you go to school, let's say university level 100, and you are supposed to pay fees of say 5,000 Ghana cedis. Okay. The fact that you have not paid, let's say 2,000 Ghana cedi of that amount, doesn't mean that your fees for level 100 is 3,000. No. Your fees is 5,000, but you are owing, or there is an outstanding of 2,000. Okay, so for expenses that has not been paid or that are due or that has accrued, we add them. We don't exclude them. We add them to the amounts that we have paid to be able to determine the total expenses for the period. That is why in the profit and loss account, you'd have to add any owings or outstandings or accrual in expense. I don't know if the point I'm making is well understood. So in the profit and loss account, you add it. You add. And I want you to remember that. In the balance sheet, this is an amount you have not paid. So you are owing, and it's a liability, but specifically a current liability, because it's expected that you are supposed to pay it within one financial year. Now, the other thing you can do is to prepare the expense account and then show this accrued expenses. Okay. So I have here an expense account, and this is how you do the expense or prepare the expense account. So the first thing you bring in there is how much you have actually paid, the expense that you have paid, and that is always in the trial balance. Okay. Then the amount that you haven't paid, okay, you add on. So you see in the expense account, we bring the amount we have paid. That's why we have cash book here. That indicates the amount that we have paid. And then we add on the owings, okay? But because that owings is a liability, we carry it down to the next period. So it's a carry down here added on to the amount we have paid. And the total will give us how much expense we are taking to profit and loss account. In the balance sheet, you show it as a current liability. So you appreciate why expenses accrued were under current liabilities. Please, any question on accrued expense before we move on? Any question? Okay. If there are no questions, then professors, please note that for accrued expenses, we add them to the profit and loss account, and in the balance sheet, we show it as a current liability. Let's go to the next one, which is the opposite of accrued expense. That's prepaid expense. Who will do the reading for me? Let me see. Professor Emmanuel Kujo. Please, can you read for us?
Let's see. Prepaid expense refers to an amount of expense paid in excess of what has been incurred. It's also called expense paid in advance. Accounting treatment in the final account, profits and loss account. Expenses prepaid is deducted from the expense paid, and the results debited to the profit and loss account. Balance sheet shown as a current asset.
Okay, thank you very much, Prof. So for the prepaid expense, what it simply means that you have paid in excess of what you actually incurred, right? Incurred. It is also called expenses paid in advance. So let me cite another scenario for us to appreciate. So let's say that you go for a business, you go for a store, right? And the landlord or the landlady ask you to pay 1,000 cedis for a year. So the cost is 1,000 cedis per year. Or let me make it 1,200. So it means every month you pay 100 cedis, 100 Ghana cedis. So that is the price of the shop. Every year you pay 1,200. Well, maybe you have enough money, so you give the owner of the shop or the landlord or lady 2,000 Ghana cedis. Please follow the scenario. The shop is 1,200 a year, and you paid 2,000 Ghana cedis. What have you done? You have made an advance payment of how much? 800 cedis. Okay, so in your final account, if you are preparing your profit and loss, if you write rent in your profit and loss account as expense, the amount you are supposed to quote there is 1,200, not 2,000. Okay, because the 1,200 is the actual rent you paid for that year. It so happens that you paid an excess. So in your profit and loss account, you have to show us that, well, I paid 2,000, but there's an excess payment or an advance payment of 800. And so your profit and loss account will show just the 1,200. That is why for prepayment, we subtract or we deduct in the profit and loss account. Again, if your school fees for the term is 500 Ghana cedis and your father goes to pay 700 cedis, if your father is preparing his account for the term, he cannot quote a school fees of 700 cedis because the school fees for the term is not 700, it's 500. So he has to tell us that I paid 700, but I need to deduct 200 an advance payment, giving us the true fees for the term 500. So that is why we subtract the prepaid expense. In the balance sheet, that amount is shown as a current asset because it's our own money. We can decide to claim it if we have not exhausted the period or we haven't incurred any expense. Okay, so for the prepaid expenses, how you show it in the profit, in the expense account. So pay attention here. Again, how much you paid is debited. Because anytime you pay expense, you debit it, right? So you see cash book here. But this time we are not adding on like the owings, we are subtracting. So you see that it comes to the credit side to subtract from the amount we paid. Okay, so that amount will be taken to the next year because it's our own money. So you see balance carried down, closing prepaid. So it is deducted from it, and whatever you get is how much you are taking to your profit and loss account. Okay. Let's quickly look at the other two, which are the accrued income. Accrued income. So let me get another professor to read that for me. Prof. Portia. Prof. Portia.
Yes, sir. Okay, so accrued income refers to an amount of income that have been earned but not yet received. It is also called income, due, outstanding, unpaid, and owings. So please.
Yes, continue with the accounting treatment.
Okay, accounting treatment in the account. The profit and loss account. Income due is added to the income received and credited is bracket added to gross profit. For the balance sheet, the accrued income is shown as a current asset.
Okay, thank you very much. So accrued income, as you read, this is income you have earned but you have not received. Okay. So how do you deal with it in the final account? In the profit and loss account, because this is money that you have earned, you are supposed to add it to your income, right? So we add it to the income, and under the other income, it is shown there where we add to the gross profit. In the balance sheet, this is your money, is your resource, a current asset. So you show it as a current asset, right? Okay, so a scenario will be that maybe a business has rendered some services and is expecting some commission. Okay, so the business has rendered the service or has earned the income by rendering the service or providing whatever. Okay, but the business has not received the amount involved. Okay. A typical example would be, let's say, a school that is expecting school fees from its students, right? So if the school is preparing its account for the term, it will include all the school fees that has not been paid or that has not been received as part of the fees for the term. Okay. So that's now these things are done based on the accounting concept or principle called the accrual principle, which says that, you see, expenses, immediately you incur them, whether you have paid or not paid, should be part of your, in your profit determination. Likewise, if you earn an income, whether you have received it or not, it should be part of your profit or loss determination. Okay, so for example, as a teacher seated here, one of my income or source of income is salary. Okay, if the government has not paid me for the month of November, in as much as I've worked for November, that money is mine, it's my asset. Okay, so I have earned it. So even though the government has not paid, when I'm preparing my account, I can put it in there as salary earned. Okay, so that's the understanding. So you add it to your profit and loss account, and in your balance sheet, you show it as a current asset. Okay. Now, if you are preparing the account, for income, the ones you received are credited, right? So any owings, you add it on. Okay, but that is not cash received. That's why we put it as a carry down, taken to the next period. So as you receive it, you credit and it will write the asset off. Okay, let's look at the last one, which will be the prepaid income. So I think another gentleman will do that. That's Prof. Michael Ajimai will do the prepaid income for us. Prof, please, let's hear you. Okay, Prof. Ajimai is not responding. Let me go to Prof. Bridget. Please, can you read on behalf of the gentleman for me? Okay, she's also not responding. Okay, I guess then I have no option than to read it myself. Okay, so it refers to an amount of income received in excess of what has been earned. Okay, so a typical example would be Mr. Amwa receiving his December salary in November. I've not earned the December salary, but we are still in November. So if the government pays my December salary now, that will be recorded in my books as an income received in advance. So that technically is not my money because I've not earned it. That's why in the balance sheet, it is a current liability. And in the profit and loss account, you deduct it, you less it because it is not your income. You deduct it from the income received, right? So that is it for. Okay, so if you have observed, we have looked at 4 of the adjustments, 6 more to go. Now, these 4, by way of summary, are accrued expense, prepaid expense, accrued income, prepaid income. The summaries on these 4 are that for the accruals, we add them. Okay, the accruals or owings or outstandings, we add them in the profit and loss account. And for the prepaid income and expenses, we less or we deduct. But in the balance sheet, they all have their different or unique forms. The accrued expense, let me go back. The accrued expense is a liability, an expense you have not paid, so it's a liability. The prepaid expense is a current asset. Accrued income is a current asset, and then prepaid income is a current liabilities. Okay, please, any question before we end this session? Any question? Any question? Any question? Okay. So I guess we would resume in the second session and then we'll continue with the others. But I think I'll prefer we look at a scenario where these prepaid income, accrued income manifest themselves so that we can appreciate how we deal with it in the profit and loss account and the balance sheet before we look at the remaining 6. So let's meet in the final session and I think we'll continue from. But if you have a question, you can still go ahead and ask. I have some 5 minutes. Okay, no questions. Thank you, professors.